Welcome to Bear Market Summit. Do you know that there is a high probability way to pick market tops and bottoms? If you want to learn how to get in and out of a trade at the most optimal time, you definitely need to hang around for this next presentation. Hi, I'm Pethuel, your host for Bear Market Summit, and I'm excited to introduce to you Hernan, our presenter for this session. Hernan is a senior broker at Summit Securities and from the Philippines since 1995 and also serves as a trading mentor at Bull Society, the Philippines' first and leading trading support and mentoring community that has mentored thousands of retail traders and investors since 2014. Commonly known as Spyfrat in many established stock forums and social media groups in the Philippines, Hernan was also awarded the Hall of Fame by Money.com after winning back-to-back stock tournament in April and May year 2000. And with this short intro, it's my honor to welcome our summit speaker for this session, Hernan Segovia. Hey Hernan, welcome to Bear Market Summit.
Thank you very much, Philly, for this warm welcome, and thank you for having me in this Bear Market Summit 2020.
Fantastic. It's a privilege to have you on board the summit to share with us how to pick market tops and bottom using parabolic and Bollinger Band techniques. And now, for the benefit of the summit participants who might not have heard of you before, especially those who are based outside of the Philippines, can you briefly walk us through on your personal trading journey? Can you still remember how did it all started for you, and what was the circumstances that inspired you to become a trading mentor for the Philippines trading community at this point in time?
Okay, I've started way back in high school days. No, there was this teacher of us that normally he will told us to go to the library to make a report, whatever topic we like, literature, history, everything and stuff, anything that under the sun. So one time when I was in the library, there was no resource material except for a newspaper, and what's left on the rack is a business section. So I have no other recourse but to grab that business section and do my report. That's what happened when I got interested on those graphs with the stock market graphs and things like that, open, high, low, close, all the quotations. That's the first thing when I was high school. But it was an on and off interest in the stock market because as we go along with the high school life, we prefer to study more with our subjects like math and sciences. Then after I proceeded with college, I took up Bachelor of Science in Electrical Engineering. I first have my interest again flowing back to the stock market. It was in at least third year college engineering that I first invested. It was not a good investment, by the way, because I have no knowledge with regard to stock market. So it started back in around the early 90s. So in 1995, I was employed by Summit Securities. That's the real stuff happened with regard to the stock markets investing for me.
I see. And was that a deliberate decision to head into the financial market very soon after you graduated?
No, not yet. I worked many odd jobs like in a ice cream factory, in a navigation company, and later on a bank. But my persistence in knowing the stock market leads me to fulfill my passion.
I see.
So that's why I applied at Summit Securities when they opened up a branch here in Iloilo City, Philippines.
I see. And you became a broker in 1995. And has that been what you have been doing all the while until today, right now?
Yes.
It's already like how many years? 15? Well, more than 20 over years.
Mm-hmm.
So you started as a broker and you're now still a broker after so many years.
Yes, I'm still a broker.
I see. Fantastic. So I'm very sure you must have watched and seen how many retail traders and investors, all the mistakes that they probably have made, right, as a broker, especially considering that you have actually gone so far, not just being a broker, but becoming a trading mentor as well. So yes, judging from what you have learned and apply versus what you see the retail traders and investors constantly doing, do you notice any things that they have always been doing very wrongly on all those times?
First, when retail investor investing is in the stock market, your time frame is always for the long term. But it's very easy said than done, no? Because those first-time buyers and investors have actually never met or experienced what is a long-term investment. So after a while, let's say six months after, they get tired and they get bored, and you wanted to play the speculative stocks. So that's where I feel in all those experience that I have on the beer markets, and I've shared with them all my frustrations that one should not be a gambler in trading the stock market. So one must have a lot of patience before pursuing investment in the stock market.
I see. So what you notice is that when those new people come into the financial market, they usually come in from an investment angle, but after a while, they all want to become a trader because of the speculative excitement. And that is where you start to guide them on taking on the right path or the right foundation to becoming a good speculator. Is that generally what you have experienced?
Yes. Because right now, social media has a lot of Facebook groups right now with regards to stock market. And usually new investor would lure into what is the hottest stock. So they would grab what is the fast moving ones without taking any consideration to risk management. So that's why I fill them up. I teach them that they should wait before they pursue that kind of trading life.
I see.
They should experience first how to invest properly.
I see. So I believe that since you have been in the market for so many years, quite a few decades already, so I'm pretty sure you would have experienced or gone through some of those more severe bear markets that has happened in the past. Can you share with us a little bit more about the bear markets that you have been through that was the most memorable for you, and what was the main thing that you have learned from those bear markets that you have experienced through?
It was in 1997, the Asian financial markets actually. I was performing very well prior to that. Then suddenly bear market came. It was my first bear market experience. I didn't know what to do. I was young, I was naive, I was careless, very impulsive, so to speak. No? So I traded the Philippine Stock Exchange or local equity markets. We can only buy stocks. There's no shorting on the Philippine Stock Exchange until now. Shorting is not been granted anymore. It's still prohibited to short stocks. So what we do now is the Philippine Stock Exchange is a buy-only market. So instead of having patience and waning off those bear market scenarios, I keep on investing. I keep on buying, bridging down, things like that. I do reverse trading. I do revenge trading, things like that. I opted for a leverage. So it was pitiful. No, it was a disaster, so to speak. So anyway, I have my first experience of bear market, and it was so gruesome that I have to teach those who I've mentored and to all my clients that bear market is a very hard market to navigate, especially in the local stocks, because we only have a buy market scenario here. So after experiencing that bear market in 1997, I was cautious to trade in a thing that defines the bear market scenario any longer.
I see. And was the subprime, the 2007 bear market, something that was major for you guys in Philippines as well?
Yes. But I was well prepared because of the experience that I have in 1997. So that one, I waited. I have my time waited for that 2007 to 2009 financial crisis as well, subprime. So I was monitoring actually copper trade, copper chart. And it was around maybe around early March in 2009 that the price of copper went reverse. So that's the time that I put money into investing again in the Philippine Stock Exchange, and it paid me well. No? So this bear market again that happened eventually we have been prepared for since around June last year. So we've been monitoring the Dow Jones Industrials, all the major US indices, and we have at least a grasp of what is going to happen moving forward. So at least investing in the global markets have a short side. So I think we've done pretty well in this scenario.
I see, I see. And you mentioned earlier on that in the Philippines, you can't actually short the equities market. So does that mean that during the let's say, for example, the 2007 bear market itself, were you all like mostly exited your position, holding cash and just simply waiting for the bear market to end before you start getting in again? Or actually, do you all use those cash to look at investing or in trading other instruments that you can easily go long and short? What was the main methodology you used to manage your cash and portfolio at that point in time?
I trade in Forex for the time being. The time from 2007, I started trading Forex. Actually, I've been trading Forex since 2000, but on a small scale portfolio. So in 2007, while the bear market is creating havoc in our Philippine markets, I navigate the Forex market instead of trading the equities, because of you cannot short the Philippine stocks. You are only obligated to buy. So it was a small investment on the Philippine stock market and a nice investment on the Forex market. So I navigated the 15-30-minute charts in the Forex market.
I see, I see. So I suppose that is how you actually minimize the opportunity cost of holding cash during a bear market, right? By looking at other instruments or other asset classes to trade. So fantastic. I'm sure you probably will, later on, you will share more about how you plan to navigate the current bear market, and possibly you might also share some thoughts about your views about the current bear market. Do you think it's going to be something that is going to be persistent, or it's going to be over very quickly? So I'm sure you're all ready to share your thoughts with the summit participants on your methodology in riding out the current bear market while positioning for the recovery thereafter. So now, to the summit participants watching this video right now, I'm sure you're just as eager as me to want to listen and watch Hernan's insights. But before we head into that, I'll take a moment to thank and introduce you to our summit sponsor.
Steve and Dave use eToro to invest in the financial markets. Steve does research on global investment opportunities. Dave does research on how to become a level 60 wizard. Steve follows the feed for the latest market news. Dave follows the feed for the latest cat videos. Steve has a watch list for promising investments. Dave has a watch list too. So why is Dave just as good an investor as Steve? It's because Dave used eToro's copy trader to automatically replicate Steve's trading activity. Whenever Steve makes a trade, Dave does too. Trade like a Steve with eToro, the world's leading social trading platform.
A contrarian approach on how to sell tops and buy bottoms using a trend following system. So let's start, and I hope I can give some hints to our audience for this presentation. Okay, so a little disclaimer. The materials that's being presented here is for information and educational purposes only. It should not be regarded as recommendation. So I hope we are clear on that. So hello, I'm Spyfrat once again. It's nice to be here on the Bear Market Summit 2020. Okay, so keep in mind, in a bear market, cash is king. So you need to be patient and mentally prepared, and you should know your edge, because trading with an edge means you have a process. And one of my experiences in the 1997 Asian crisis is that I keep on investing even though it was a bear market, and it was, I have said earlier, it was very disastrous for me. So a thing or two that I've learned in those bear market in 1997 is that it is very important to at least preserve your capital, because once your capital is depleted, you cannot start right away. So for here, we say that cash is always king when it comes to that. So you need to be patient, cautious, but not hesitant. Once the opportunity is given to you, you should take it. Be aggressive when you see a reversal, and one should be emotionally matured to take risk, because it's a mere fact that once an investor or trader disregard risk, things may get ugly. So just like what happened to me in 1997 Asian financial crisis, I was like a Superman prior to that, but because of disregarding the risk management side, I ended up not very well. In fact, it was gruesome to speak of. So knowing your edge back then, what you have learned might put you in well prepared for the next bear market if you see one is coming. So whether your edge is about fundamentals or technicals, you have to harness it. You need to master what you have. You have to get the feel, the instinct to supersede whatever emotions that you're going to experience on the bear market, because let's face it, when bear market comes, there will always be a panic, a stampede, so to speak, because people are afraid to invest, and that will be your edge when the right time comes. So along with that, it defines you who exactly you are. It defines you what kind of trader or investor you are, because each one of us is unique individual. So having a process in mind keeps you not clueless, no? It gives you the perspective what to expect and what the plans you're trading into the market. So having the edge is like having your own mojo. So to the word of Steve Austin, find my mojo. So everyone should find what the edge of being a trader or investor. So my audience, no, retail traders with less than 2,000 capital, we have a maximum allocation of 25% per trade, so that's roughly around $500 per trade. Maximum portfolio net drawdown of 12%. And portfolio should be focused on FX, equities, and cryptos. So if you have a position in equities and you have another position on FX pair and cryptos and commodities, that would be fine. Okay, so about my trading system, I use a custom Bollinger Band setting that measures the volatility around a 50-period trend and a relative strength indicator, no, or index with a 30-period lookback. Later on, I'm going to explain to you what's the look of it. And more than the custom settings, the edge comes from my theories and framework for trading parabolics, an area that studied and specialized in for over 2 decades. So along the way, I've been accustomed to a single trading process involving only 2 indicators, Bollinger Band and RSI, 50-period trend, 30-period trend, and I harnessed those 2 indicators on my own advantage and usage. So my parabolic framework combines with technical aspects of parabolics with crowd psychology, where my edge exploit the start and end points of parabolic trades. Later on, I'm going to expound all of this. So this is my trading system. Bollinger Band set at 50 period and standard deviation of 0.2. So if you can see the 3 oscillating lines here are the B bands, 50 and 0.2. This is not a typical default of 50 and 2 standard deviation. So you might see this as actually 3 moving averages, but it's not. It's actually the 0.2 that is the lower band in the higher band. So relative strength index indicator with a 30-period look back. So for the past 20 years, I've been using RSI 30 and not the default of RSI 14. So technically, my system is designed for trend following, but over the years, I've developed rules that adjust to different market conditions, which I trade using one system only. So how to sell tops at trading age, no? Okay, here, in my experience, whenever I see patterns during parabolics, that's when the things gets messy or ugly. So RSI parabolic theory a stock is in parabolic when RSI 30 is greater than 70. So whenever we see RSI above 70, it is considered as parabolic status. So you can ignore overbought conditions when the stock is in parabolic status. So typically, a classic textbook approach would define RSI 70 or above as in overbought conditions. But here, there's no such thing as overbought conditions, but only in parabolic status. So you can ignore bearish divergences when successive impulsive RSIs are above 70. So whenever the stock is in parabolic, big moves do happen. So let's enjoy the run. So, but as soon as wedges like this one, triangles or pennants develop while in parabolic, start selling longs and look to short already. So we have here a pattern that's been occurring inside the parabolic status like this one. So symmetrical triangle. So that's the time, or the parabolic pattern suggests that imminent danger is ahead. And as you can see in the chart, it went down as much as 52% loss. Okay. Okay, sell patterns during parabolics again. When patterns emerge during parabolic run, close longs or stay away, otherwise look to short. So here we have another example. I think this is Apple recently. It created another sell pattern. So while in parabolic status, so it dived 35% afterwards in a few days span. Okay, so even Bitcoin was inspired from a pennant sell pattern. So we can see here Bitcoin forming a sell pattern while the stock is in parabolic status. So to sum it up, if you see a sell pattern during parabolics, it signals the stock is headed for a plunge, or the stock is going for a waterfall. So here we saw Bitcoin coming from its high and made 84% loss. So, okay. Edge number 2, bearish divergence. For edge number 2, we'll discuss another form of parabolic killer called the Pethuel Bearish Divergence, or PVD. I name it after a friend of mine whose name is Pethuel Pumaloy from the Philippines, because after I presented my theories on Facebook and in Twitter, he made a study. He back tested all those bearish divergences and made a study with it, and along with it, he get a very bird's eye view of how parabolic killer Pethuel Bearish Divergence would sum it up. So the PVD can provide a very strong warning signal that the price is vulnerable to a depth correction. So, and when PVD occurs in market indices such as NASDAQ, S&P 500, or Dow Jones Industrials, even our Philippine Stock Exchange Index, on a higher time frames like weekly and monthly, this is a signal that the market top is in place, and that this condition can trigger a bear market type correction. So I'm going to present to you just the chart of Dow Jones later on. So here we have Pethuel Bearish Divergence. Its condition is actually very simple. A first RSI impulse triggers a parabolic. So this is the first RSI in parabolic status. So it's above RSI 70. Wherein a second impulse is lower high RSI versus the first impulse in below 70 level. So this one is below 70 level. So this is the first price high, and its RSI is around above 70 level. When the price breach the previous high, its RSI does not go above 70. So those two conditions made it to become a Pethuel Bearish Divergence. It's actually a bearish divergence, but more defined as a Pethuel because of the risk being involved, because PVD conditions are unusual as price corrections are typically deeper than the regular types of bearish divergence. The rest can be slow at first, and then it can move fast. So we have here an example of, I think this is a Zoom trading in the US equities. So here we have a Zoom video. We have a Pethuel Bearish Divergence here. So it made the high, then we plunge around 20+%. So this kind of parabolic bearish divergence suggests that the top is in place, no, for the kind of price in the stock. So how to set up a PBD trade? If you can see here, we have a chart of West Texas Oil using a 30-minute chart. So if the audience may so, we have here the high. We have here RSI at around 70 level. Then it's another high, but its RSI did not meet, no, or supersede this previous RSI. So it's a Pethuel bearish divergence. So using a 30-minute, any time frame, if the stock have a Pethuel bearish divergence, it follows that it moves, go down. No? So as what the West Texas Oil on the 30-minute chart did. So the price coming from around 55, it moved down lower. Okay, so how to buy bottoms, another trading edge that I've been experiencing and modified. So edge number 3, buying the bottom. We called it the Bebemon, so it's a kind of funny name because it stands for actually Bollinger Band Monster. So actually it is a buy signal triggered when the price crosses, no, the B band from below and RSI 30 breaks the level 50. So a Bebemon setup takes a long time to develop, so you need to patiently wait. Again, we should be patient in our trading decisions. No, we don't rush things. We don't do impulsive things for it. So before you commit, no, you should wait for it to trigger a signal to trigger. So in trading, to be early is to be wrong. So don't be early. Okay. The setup can be applied to any instrument across different time frames. So the waiting game is relative to the time frame. So if you're using a 15-minute or 30-minute time frame, so the waiting is a little bit shorter compared to the ones that you're using. If you're using one is daily or weekly charts. So Bebemon trades can be applied to securities that have been badly beaten up, meaning the stock price has been going down. So it is actually a reversal kind of technique, no, or an edge for us. So as a reversal setup, this upside is significantly bigger compared to the rest that is being it is manageable. So we have a very good risk-reward ratio here, if for the Bebemon trading edge. Okay, so I'm going to show you how does the Bebemon look like. So we have here an FX pair, euro against the dollar on a 4-hour chart. So we have here the price breaks down, no, from its Bollinger Band, and price and RSI triggered below 50. So this is bearish anymore. So as the price goes down deeper, we waited for the signal to commence when the price goes above the B band and the RSI goes at 50 level. So we have here a Bebemon scenario. So luckily, the price moves up in our favor from here. So another one, Bebemon on Tesla using a 65-minute chart. So I think Tesla's been very the pick of choice of most retail investors, no? Other than the fund managers, of course. So we have the price going down. So we have here the B band here. As the price breached the B band, it breached the level 50. So it triggered a buy signal for us. So it goes up. So that's very simple. But here, if you can see, RSI goes parabolic for a while, but the price increases. So we have a new price taking over the previous high of Tesla. But here, the price dropped due to the gap because of trigger around another kind of Pethuel Bearish Divergence, I think so. So Bebemon on West Texas Oil for our chart. We've been following this for many days right now. So we have here guidelines for Bebemon. We need to find a time frame with clean and clear interaction between price and B-band. So here we can see a very clean chart. The price of WTI dropped below the B-band, and RSI level 50 goes below 50. So this is a sell signal, and it goes down. If you can see, the RSI only turned back above 50, and when the price breaks the B-band again, so this is a long signal, a buy signal for us. So if you shorted here at around 50 level, you would be covering here at around 20 level. Or if you're not short, you can buy here and probably sell here, because this triggers a sell signal, because the price breaks below 50 and the RSI below 50 level. So setup is just very simple. No? Bullish if price is trading above or around the B bands in a narrow range, and RSI is above 50 level. So bearish setup goes if the price is below around the B band and the RSI is less than 50 level. So right here we've been waiting for the West Texas oil to reverse again and to trigger a buy signal. So at this juncture, no, we are long on West Texas oil using the 4-hour chart. So by the way, this is the chart of Uwanda. So price midday first. If one is using another kind of platform like eToro or TradingView, so they have different pricing. I'm using Uwanda trading platform. So this is the West Texas oil price right now. So we are long on here because the price is above B band and the RSI is above level 50. Okay, so my cut loss point would be if the price breaks below the B band again. Okay, it's a very simple actually. Okay, some charts, no. Here is a Dow Jones Industrial. First high, this is one. It triggered a parabolic status for this high for the Dow Jones Industrial at around 2700s. I mean 27,000 level. So it made another high, surpassing this high, but the RSI was way below 70. So it triggered a Pethuel Bearish Divergence. So if you can see, the Pethuel Bearish Divergence manifested last October, prior to that October high of the Dow Jones Industrial. And what happened then was it plummeted to around 23,000 level. So if you can see the havoc that the Pethuel Bearish Divergence created on the Dow Jones Industrial average. So eventually we have a count here, but that will be another topic. We call it the RSI Full Cycle Trading Framework created by Jet Mojica of the BOH. So it will be another, a study to talk about. So right now we have the basics of Pethuel Bearish Divergence. So we have here RSI resistance that when the price break, we're going to see a price spike. So this is the Pethuel RSI. So our theme here is to sell or near this level when the Dow Jones make another new high. So from here, we see that the Dow Jones have tested those levels prior to that, and it made another Pethuel Divergence. So if you can see, we have a Pethuel Divergence here, and we have another here. So RSI is above 70, parabolic RSI. This is the previous high, and we have another high here for the Dow Jones Industrial average. So, but the RSI here did not break 70. So this is a Pethuel Bearish Divergence, and it was halted by this RSI level here. So it dropped because what is happening right now, sadly, unfortunately, because of COVID-19 virus. So, but before that, we have no clue or whatsoever what's going to happen or what will be the catalyst back then. So we have here right now the full cycle of RSI framework, and we have a 1, 2, 3, 4. So I think moving forwards, we're going to see Dow Jones Industrial, just like what is happening right now, going up from here. So I don't know if it's the effect of the Fed intervening the market or what, but the count right now is being favorable to the Dow Jones Industrial Average. So we have here on a monthly basis another type of Pethuel on the monthly side have manifested itself. So we have here the RSI high, but it was negated because the RSI here have moved above the parabolic status here. So we take this high, and this is the Pethuel Bearish Divergence. So right now we have 1, 2, 3, 4, and this is the 4. This is a long-term uptrend chart of Dow Jones Industrials for the monthly chart. And I think for the coming months, it's going to go around this level, 5. So I don't know. But as what the chart is telling us, going to 5 is favorable for Dow Jones Industrials. So some special case that we've been studying for the past 4 years or so. This is the parabolic fractal structure. So we've taken the monthly gold as our clue. I would like to credit whoever have this chart. I just found it in the net. So we have 4 phases for the whole parabolic fractal structure of whole parabolic structure. Now we have 4 phases. We have the parabolic pattern. Phase 2 is triangle, and phase 3 is the greatest bear trap ever. So it's quite a unique name. And phase 4 is Tuda. So what does it mean? Tuda, to the moon, to the sun, but we call it only Tuda. So we have here a phase 1. This is the parabolic pattern of gold way back from 1970. This one. So we have a triangle here. So since this is ascending triangle, a bearish triangle, everyone expected to move the price going lower. But we have a phase 3 here called the greatest bear trap because it is a trap for the bears. Because first and foremost, it's a bear pattern. And after which it moves higher. So this is phase 4. So we have the stock example rate that we've been following. That is a gold monthly chart. It's been occurring again recently. So for the past 2003, we have the gold monthly chart until the present, manifesting itself into the four kind of phase of parabolic structure. So we have phase 1 here, the parabolic pattern, when gold move alongside. When the price of gold moves around 2,000 per ounce, no? So we have here a triangle, and we have here the PSP3, the phase 3, or the greatest bear trap ever. And currently, I think the gold is in phase 4, so Toda. So we pick the gold price to around taking the price of 3,000 level, moving to around 3,500 or to 4,000 per ounce within the next 2 years or so. So we have here another Regeneron Pharmaceuticals, REGN, same scenario, same fractal structure. We have here a weekly chart of REGN. So we have here phase 1, the parabolic pattern, phase 2, the triangle, and the phase 3. This is the greatest bear trap event. And currently, REGN on a weekly chart is in phase 4. So it's doing some pullbacks right now because its daily chart have triggered a Pethuel Bearish Divergence. But moving forward for long-term structure using the weekly chart, we're going to see, I think, RGN breaking 1,000 level, moving forward to 1,200, maybe 2021, mid 2021. So we have here RSI testing the RSI wall at 68. So that's why the stock price have made some pullback. So we're waiting for this one to to buy back the price when the signal in the daily chart manifests itself. So, okay, that will be my presentation, and to God be the glory.
Hey Hernan, that was a really insightful presentation. I'm sure the summit participants now have a better understanding on how to use a parabolic and Bollinger Bands effectively to actually trade their portfolio. Now, to further help the participants understand more about the topic that you actually share in your presentation, shall we head into the Q&A segment so that I can get you to clarify on some of those points?
Okay, sure, Belo.
All right, fantastic. All right, so you mentioned that earlier on just now that when we are entering a bear market, your suggestion is to hold on to the cash and be patient about deploying the cash too early into a bear market. So can you share with us, is there anything else that you can actually, other than just holding cash, what are some of those things? You mentioned earlier on that you actually trade Forex. Can you share with us a little bit more about what is your strategy to using your cash during a bear market?
Oh, yeah, okay. So right now, I'm mostly doing Forex trade and some short side on equities market. So I employ some of my cash trading in the Forex market using only shorter time frame, only 15 minutes to maximum of 4-hour chart. So right now, we are long on US CAD. And as I mentioned earlier, I'm long on WTI. So once the opportunity again for a huge reversal on big names, I mean on the US equities and as well here on the local market, I'm going to deploy some of that to equities. So right now, just to get ahead, right now I'm diversifying some of those cash for the Forex trading.
I see. So does that mean that you're also trading the US market on top of the Philippines market? And now that you mentioned that for Philippines, you can't actually short the stocks, does that mean that you might actually look at shorting stocks, let's say, for example, in the US market or other markets which short selling is allowed?
Yes. Right now, we are short on Zoom. And because of the Pethuel Bearish Divergence, we are long on, I think, TVIX. Most of our students there at BOH Society is long TVIX. And actually, I have some crown stocks, marijuana stocks, but very manageable. And for the Philippine side, we have less participation right now. Most of our students have eventually ventured into global markets because they can navigate more, buying long and selling and shorting stocks as well. And we have lots of names there to trade. Here we are stuck with some big names, but we cannot short it. So most of us are trading Forex, cryptos, and on the global side, equity market.
I see. So actually what we are seeing across global equities market over the past 1 month is that there has been a very strong rebound. So is that an occasion based on the methodology that you use that suggests that the past 1 month was actually an occasion where people can go long again on the stocks?
We don't go long that much. We always employ a proper risk management. Normally, we tell our students to just leverage a maximum of ×2 or ×5. Better if they can only pay it ×1 or cash on cash event. So, but there are some of those students who get excited and we reprimand them, especially if they're trading gold and oil using 50 times leverage, then it's a no-no for us. So we reprimand them via our own platform. And we emphasize again the proper risk management that if you want to stay long on this market, you need to have a proper risk management.
I see.
So, but once in a while they get excited, things like that. And so Jet, Jojo, and I would normally continue again to remind them the importance of risk management.
I see. So in your presentation earlier on, there was this part about the target audience. You mentioned that generally what you suggest is that 25% per trade. Is that actually 25% per trade or 25% per asset classes? Because you mentioned things like Forex, equities, and crypto after that. So I just want to clarify that 25%, is it based on asset classes or individual trades?
individual trades. But if they want to diversify, because some of the students haven't tried Forex yet, so if they want to diversify, at least they only allocate 25% of those funds trading the equities or crypto side of the market, no, or even the Forex. But at least they are aware that they're trading not to give all in or not to give in to greed or things like that, and must allocate a maximum 25%. So as much as we can employ them to do that, they need to diversify into Forex trading and equities and crypto and commodities. Some of our students have not yet done so because they would prefer trading equities instead. So for students that are just trading equities, we allocate 25% max for every trade. Yes.
I see.
So,
and what would be your suggested ideal number of trades to diversify? Because I mean, the way I look at it is that if you have, let's say, fully deploy your capital, you will have a maximum of 4 trades if you are basing on the 25%, which means that any movements up and down, especially considering the current volatility, you could see your equity curve having a very strong up and down kind of movements, which is very destabilizing psychologically. So what would be your suggested ideal number of trades in a portfolio, even like, let's say, for example, based on the $2,000 as a starting point?
We normally tell students to allocate certain percentage of cash. So 25% cash and the rest 75 going for equities or Forex pairs, things like that. But if they can do 4 type of equities, no, say 4 type of stock within a day, they need to liquidate a part of it, because we cannot, especially that earning seasons right now, we cannot. There will always be an earning surprise, and prices tends to gap up or gap down. So we need to allocate certain kind of cash position. And when the right time comes for being aggressive, then it's the right time to allocate more percentage to full swing, invested fully on the equity side of the market.
I see. So I understand from your presentation that the main strategy that you're advocating, or what you are actually very familiar with, it's using 2 main things, right? The B bands as well as the RSI above 50, or the price crossing above the B band to actually initiate a trade. So is that considered as your trading setup for a buy trade generally?
Yes. But first of all, we need to find a trading time frame that corresponds or interact well with the price and the B-band and RSI. So if we cannot find it in a 15-minute time frame, we look for the 30-minute. If not for the 30-minute, we move higher to 1 hour or 4 hour or daily. If the interaction is a bit messy or noisy, then we skip that kind of stock or instrument and move to another stock that our screener have posted.
I see. So when you mention messy, does that mean that if, let's say, I open up a chart based on, let's say, a 1 hour time frame, and I see that the price keep on going up and down, I crosses the B band frequently, is that what you call as messy? That's a consensus?
Yes, that's messy, and we tend to avoid that kind of time frame. So we look for another time frame that is interacting well with the B bands in the RSI level 50.
So does that mean that your workflow generally is, let's say, if you are interested to actually trade this particular instrument, you will bring out the B bands, and then you will look across the different time frame chart, like 1 hour, maybe 4 hour, and daily, weekly, to see which is the most ideal time frame to look at for
yes, definitely. So for example, when we go along on a 4-hour chart of WTI, the 15 minutes is quite missing. So we tend to find a time frame, and we found out that the 4-hour chart interacts well with B band price and the RSI level 50. So we stick to the 4-hour chart for the WTI.
I see, but you wouldn't remain like that forever, right? Because sometimes the characteristic of that instrument might change over time. Let's say, for example, let's say the S&P or the Dow Jones, for the past few years, they have been like going up gradually, and then suddenly this very sharp decline and very sharp ascent, then it totally changes the time frame that is suitable for using the B-band. Am I right to say that?
Yes. So if that happens, we tend to skip that instrument.
Okay. So you tend to skip that instrument.
Yes, we don't trade such things or such instrument that is not reliable or not in line with our interaction with B-band and price. There are lots of instruments to trade with to start with, no, and instrument with messy or unclean charts we tend to ignore.
I see. So one of the difficulties for most equities trader is that there are like many stocks out there. I mean, for Philippines might not be that many, but if you are, let's say, looking at the US market, there's so many stocks out there. So even though if let's say I might be using your methodology of using the B bands as well as the RSI to find a trading setups or to identify ideal time frame of the trading setups, but how do you actually narrow down that huge list of equities available into a manageable one to apply this strategy on?
Actually, when I started joining the BOH Society in 2016, JET has this kind of algorithm in quants program, screening stocks, things like that. Right now, we are on River, and we are going to MS Teams right now. And there's that kind of guy, Jet and Walter. They provide us with screeners. Which stocks that goes above 70 level, stocks that are in parabolic, stocks that have RSI below 30, or stocks that have been nearing the 50 moving average, things like that. So he's the one, Jet and Walter, they're the one who've narrowed it down for us because of their program in Ami Broker and the quants. So we tend to look at those screeners, which type stock to navigate or to trade with. So, for example, Zoom, it pop up when the stock moves parabolic, whereas the price tends to move higher despite its RSI lower. So then somebody in the group posted earlier that Zoom is a PBD. Then everyone is going to study it. Then we have a consensus that it was a short trade. Within the BOI Society, they are very resourceful, and help comes along the way. Not only for us, but for those within the society itself.
I see. So on that point about Zoom, right? So do you guys actually consider any fundamental potential to the stock that you all are looking to short sell, in this case, for example, Zoom? Because I mean, from a fundamental or from a business angle, Zoom, at least right now, it seems like it's the most popular app that people are using to conduct business as usual, which could also offer some people some kind of fundamental upside in the company itself. So do you guys actually consider all the fundamental aspects on top of the technical aspects that you guys see that shows that it's a potential short at this point in time?
Actually, there are guys posting about Zoom fundamentals in a group. Like because of coronavirus, lots have been using Zoom, like in schools, like in team meetings, things like that, conference. That's the reason why it moves higher, or it was the favorite as of late, no? But I think the technical side of Zoom have created such a way that it triggered a FOMO rally. That's why it breaks a previous high. Whereas its RSI is not, it's below RSI level 70. So I think Zoom was in FOMO, and we took advantage of that, trading short side of Zoom. And right now, Zoom is nearing the B band again, providing support. So we might as well cover shorts. I think some of the guys have already covered shorts because the price is nearing the B band, as shown on the chart earlier.
I see. So one of the main trading entry criteria that you mentioned was when the price crossed above the B band and when the RSI crossed above 50% level, you actually look into getting into a trade, right? So under circumstances where if let's say the price after a parabolic move has pulled back to the B band and showing signs of rebounding off the B band, would that also be a potential buy entry criteria as well, rather than waiting for it to actually cross over?
Yes, because when the price, when the RSI coming from a high parabolic reading goes around 50 level, then that 50 level would provide a very nice support. So we tend to buy on that kind of scenario as well.
I see. So those are another potential kind of trading entry
Yes.
setup as well.
Yeah.
I see. And I noticed on your B band, you I just want to clarify this. It seems like what you do is that you narrow the entire B band until the three lines are almost together. Is that what I'm actually seeing?
Yes. So
okay.
It's very favorable to the stock, no, to the instrument that we've been following. If the bands gets narrow, then it's suggesting a type of signal, whether to continue going down or continue reversing, or it will reverse. So the narrower the B band, the better. So because if one is only using a 50 moving average, it lacks a little bit of ingredient to the trade, because with the B band, if the B band are not have a huge discrepancy with regards to the 50 moving average, we tend to wait for it to become narrower. So the slimmer the B band, the better.
I see. And does that mean that actually like things like exponential moving average might be something that is close to the B band kind of way of analyzing the market as well?
I've tried it before. It's probably the Keltner channel, but I'm more comfortable with the B band with 0.2 standard deviation.
I see.
It's not what the great Bollinger Band have been teaching us, but kudos to him. His indicator is very, very helpful to us.
I see. Okay, so from my personal experience is that any strategy, regardless how good it might look, that there is always some downsides and cons to a particular strategy as well. So based on the strategy that you mentioned in your presentation, are there any circumstances or issues that could become a negative point or a downside of the strategy? And how do you go about identifying those kind of situations?
So if one is using the Bebemon parabolic and parabolic theories that I presented, one must be disciplined enough to, once the trade goes against to your position, you must cut it right away. So if you bought, for example, WTI using a 4-hour chart, the price above the B band and RSI level, that's a buy signal. But let's say if the price moves lower by whatever catalyst they might be, then you should cut your position. So you may incur losses, but not that big, because you've been using the B band along the way for it to trade.
I see. And when using this strategy, are there any situation or occasions where you might get significant losing streaks, and what kind of situation might cause you to have significant losing streaks?
If the price consolidates. So, for example, if I'm using a 15-minute chart, interaction there previously was very good. Then, if the price consolidates, meaning it goes back and forth with the B band, and I keep on buying that kind of consolidation, then I tend to limit only my downside to 2 trades failure. So if I bought and cut and bought again and cut, then that's it for me.
And what will you do?
That. No more third buying or selling. That would be finding another time frame. So,
okay. So you will actually stop trading that instrument, right? It's not that you will stop trading totally, right?
No.
Okay. So you will stop trading
trading that instrument on that time frame.
So you will actually turn to some other time frames.
Yeah.
I see. Wow. Okay, that's nice. And generally from a portfolio angle, how would you suggest, let's say if you're using this strategy, and from a portfolio angle, is it still maintaining like you allocate 25% to a certain asset classes and 25% on another asset classes? In terms of diversification wise, what is your strategy in terms of doing that?
So if I wanted to get aggressive and the signals are there, I tend to buy a maximum 4 stocks for my portfolio. So be it a combination of FX, Bitcoin, or equities, but I tend to close at least one portfolio before the market closes, especially on a weekend. From experiences trading forex market, I tend to have better result if I have no position at all before weekend comes. So that was part of the forex trading. So in equities, I tried to skip stocks that having an earnings call on that day. I tried to avoid that prior to that day. So it's very important to know the earnings calendar as well. So because those stocks tend to surprise maybe at your advantage, then that's good. But if they if you're long and they mess like what did Amazon happen, they gap down hugely. So that's out of your reach anymore. So a proper risk management is always put you on the long run for this game. So for me and for our student, I think we put a little side of cash always on the portfolio and not to go all in on those stocks.
I see. All right, so Hernan, I'd like to ask you, for the fun sake, a crystal ball question. Okay. Considering the current kind of market condition that we have seen in February, a very bad crash, and then in March, a very strong rally, what is your general thoughts about the global equities market? What is your thought about what is it likely to happen, let's say over the next 6 months or 1 year, based on all the macroeconomics that we have seen? Do you think that we are actually near the end of the bear market, or is it something of like just the start of the bear market, if you have to take a stand on it?
Okay, if we just define bear market right now, I think US market is in a bull kind of market right now because they come above 20% from the lows right now. But there's one thing that I've learned over this many years or so, is that you cannot fight the Fed, man. You cannot fight the Fed. So if you keep on putting your biases ahead of your trading gain, you may end up being bearish right now and gonna miss some of the funds that the market is going to provide, especially if they go full swing on a reversal. But on the other hand, if you go full aggressive on those kind of scenarios as well, and suddenly the market tanks for a second wave of coronavirus, so to speak, no, God forbid, then you might holding the bag again. So right now, if go easy with the flow, trade smoothly, trade with the proper risk management. So even if you are not fighting the Fed, keep abreast of the market and be cautious as always. So right now, if you are fully invested, take some of those investment and put in cash, so that whenever if the Fed stimulus package is not been going well, and a second wave of coronavirus will take the market to it right now, and you have cash to deploy, whether taking long or short position.
I see. So Hernan, as a broker, do you actually notice the past 1 month there's a lot of people opening up trading accounts to get long into the market? Because that's what I heard from some people.
Yes, actually here in the Philippines, we have lots of inquiry. Even though they cannot come here to the office, through online, I've been sending a customer account information form for them to fill up. Actually, so it's kind of weird on the previous bear market, because on the previous bear market, people are scared. And right now, here in the local front, people are actually trying to buy cheaper price of the market. So there are people who have been sidelined long enough, I think, waiting for this to happen. And I think this is the kind of opportunity that they have been waiting for. So those people that have missed the great bull run prior to this unfaithful event have actually come up and made inquiry over us to trade the local equity stocks. Again.
I see. And it seems like there seems to be a two very adamant groups, right? One is feels that the bear is not over and we are going to see much more worse
Yeah,
things
that's true.
come. And there's another group like all these traders who are eagerly opening up new trading accounts to quickly want to get in because they are scared of missing the boat. So finally, before we end off this session, Hernan, based on the experiences that you have navigating past markets, bear markets, what would be one or two advice you will have for all those independent retail traders and investors for them in terms of the current kind of situation? What would be the top one or two advice you have for them in terms of managing their psychology and managing their emotions while navigating through these uncertain market conditions?
Okay, first and foremost, if you wanted to start investing, start small. And from here, we can build your portfolio up. So for example, if you want to start on $1,000 investment and you see your portfolio dropping like 50% and you have this feeling that you cannot sleep, you cannot eat well, then let's stop. Okay, don't add more. But if you have your $1,000 portfolio and you find the price cheaper to add again, then let's continue investing. Because in my experience, new investor would find themselves in a dilemma of defining what is a long-term investment for them. Because as I've said earlier, the idea is to invest long-term, but once they're into the market, and they see people cheering for this kind of particular stock, they forget their investment and wanted to join the bandwagon right away. So number two is they should be emotionally matured in taking risk. That's very important. So if you're overjoyed to join the market right away and put all your resources, don't. And actually three, and don't treat the market as a casino. I've been there. It's no good, man. It's no good.
Fantastic advice, Hernan. All right, so this has been a very fruitful session for me to learn from you, and I'm sure the summit participants benefited greatly as well from your sharing. So thanks again, Hernan, so much for your participation in this summit.
Thank you very much for having me here, Philip. It's a pleasure talking to you.
Nice. So now, for those of you watching this summit video right now, if you would like to keep in touch with Hernan and also check out BOH Society in terms of, especially if you're based in the Philippines, check out BOH Society in terms of what you can actually get from Hernan's mentoring in the society itself. So remember to click on the web link provided below this summit video to learn more. Right. So with that, we have come to the end of this presentation. I'm your summit host, Philip Teo, and I hope you will continue to learn and apply the wonderful teachings from the many great speakers that we have invited on board this summit. All right, take care and we talk soon.